What is going to happen to the U.S. housing market in 2025? Are we going to see mortgage rates go up? Are we going to see inflation go up or down? Are we going to see an increase in inventory? On today's show, I'm going to be diving into my 2025 housing predictions. I'm Kathy Fettke, and welcome to the RealWealth Show.
You're listening to The RealWealth Show with Kathy Fettke, the real estate investor's resource.
As I said, today I'm sharing my housing market predictions with you all. But before I pull out my crystal ball, I did want to note that predicting the housing market is extremely difficult. And many large companies with lots of data behind them just got it wrong last year and the year before and the year before that. So we do our best, but no guarantees. It does help, though, to have an idea of where things are going so you can make good decisions for next year. We also have several unknown factors that could influence the housing market, such as, of course, the new administration coming into office. So what I challenge you to do is take these predictions with a grain of salt, and most importantly, think about how to prepare for uncertainty. How can you build a sustainable business no matter what's going on in the greater economy? Well, let's start with my first prediction. Will the Fed cut rates in 2025? Well, we do know that the Fed just cut rates by 0.25% on December 18th. And at the FOMC meeting where they did that, they predicted that they would do about 2 more rate cuts in 2025. Now, will that happen? Well, that depends a lot on my prediction number 2, inflation. Where is inflation headed in 2025? Because if we see more inflation, then the Fed would probably not cut rates in 2025. If we see inflation stay around 2% or even go down, well, they might cut more than 2 times next year. So what would cause inflation in 2025? What we've seen over the past 4 years is if there's too many jobs, if the job market is too strong, and too strong is what the Fed considers under 4% unemployment. Right now, we're around 4.2%, right at the Fed's target. But if we started to see unemployment go down, meaning a stronger labor market, which makes it harder for businesses to find employees, so they have to pay more. And when you have higher wage growth, then people spend more and that creates inflation. So bottom line, to sum it up, if we see increased job growth that creates wage growth in 2025, that could lead to inflation. And I'm going to talk about why that might happen in the fifth prediction with the new administration. But let's just say, spoiler alert, the new president, the incoming president, Trump, is planning on creating more job growth. So that could create more inflation. And of course, there's the tariffs and so forth. So if I were to make a prediction of whether or not the Fed would cut rates next year or not in 2025, I'm starting to think that it would be, like they said, 2 cuts, but probably less. That's just my gut. That, we might get 1, maybe 2, but I don't think it would be early in the year. We'd have to see things slow down a bit more in the beginning of the year, and that is just not happening. Again, because just recently we saw jobless claims come down in the latest report. It was lower than expected. That means people aren't losing their jobs. That means a pretty strong job market. And then we also have been seeing inflation creep up anyway. So that's my prediction. Maybe 2, but probably more like 1 and maybe even 0, but we shall see. All right, prediction number 3. Where will mortgage rates be in 2025? Well, this is all related. If there is inflation, which I'm predicting there could be and probably will be, because I think we're going to see a really robust economy. And that, again, creates inflation. And mortgage rates kind of follow inflation as well. The Fed's following it, and the bond market is following it. Mortgage rates are really more tied to the bond market, not as much to what the Fed is doing. But the Fed and the bond market are kind of looking at the same thing. And just over the last week or so, and again, I'm recording this on December 19th, so things may have changed. But just over the last 24 hours, we actually saw the bond yields go up. The 10-year Treasury went up, and it went up pretty dramatically. So the bond market, bond investors who are very, very savvy, and they're quicker to move than the Fed. They see something and they move. And when the yields go up and when the 10-year Treasury goes up, that means bond investors are kind of not investing in bonds. They're taking their money and they're putting it in stocks and other things that inflate. Again, spoiler alert, that word inflation. If you're an investor, you're not going to want a low treasury return. That's just or a mortgage bond. And if you're investing in mortgage-backed securities and you're getting a, I don't know, 6% rate or whatever, 6 or 7%, but you could make a lot more in the stock market, that's probably where you're going to put your money. So these are just clues that if a bunch of bond investors think that maybe we're going to see inflation coming up, then we should pay attention. And that's not good for mortgage rates. That means a lot of companies, big companies like Fannie Mae, are actually expecting mortgage rates to come down in 2025. Not a lot, and probably not below 6%, but kind of in the low sixes, maybe 6.25%. I am now thinking maybe not. So my prediction would be it would be kind of where it's been, 6.5 to 7%. I'm sorry, everybody, but that's just what I'm seeing. That's what the tea leaves are saying right now. Of course, anything could change at any time. Now, prediction number 4, will housing inventory increase in 2025? Well, a lot of large analytics companies are predicting that inventory will actually rise. And if you want to hear what other large companies are predicting, like Redfin and Zillow and Fannie Mae and so forth, you can listen to my other podcast, Real Estate News for Investors. And we just covered it for a whole week. We covered what other companies are predicting. So I'm kind of looking right now at what they're saying and also just what I'm intuitively thinking, putting all these things together. So will inventory rise? If inflation goes up and if mortgage rates go up, then I do believe inventory will continue to climb. It already went up 27% year over year from 2024 to from 2023 to 2024. So if we see the same dynamic, which basically is very, very unaffordable market, right? If we see mortgage rates continue to rise and home prices are still so high, people just are having a hard time buying. They're having a hard time selling. A seller's having a hard time finding a buyer. And if somebody really needs to sell and they're putting their house on the market and it sits longer, well, that creates more inventory. So I am predicting also that we would see an increase in inventory. Now, if we're completely wrong about all of this and mortgage rates come down, and there is a chance that could happen, I'll talk about that in my next prediction. If rates went down for some reason, we would see people on the sidelines gobbling up inventory. I think it would happen overnight because every time rates have gone down to the low 6% or even below 6%, people come flooding into the market. So if we were to see rates come down, and I'll talk about what could cause that in just a bit, then we would go back to limited inventory because there is so much pent up demand. As you know from my other podcasts, we have a huge population of millennials now at first-time homebuyer age, forming families, forming households, having kids, pets. They need a place to live. And when you are starting a family, oftentimes you just kind of want to have your own home. So you just know you get to stay there. You don't have to move if all of a sudden, the owner wants to sell their rental property or whatever. So, or you could customize your home. So, if you're forming a family, oftentimes people want to just own the home so they have that kind of security. Now, moving on to the best market and the worst market for 2025. Okay, this is really hard to predict. And some people might say, Austin prices have gone down so much. That must be a terrible market. And I kind of think otherwise. I love distressed markets. I love markets where there's a lot of inventory. In Austin, we're seeing prices come down. We are seeing increased inventory because they have too much supply. It could be a good time to buy in Austin. It doesn't fit my investing strategy because those properties are still expensive and don't really cash flow. But if you were thinking about getting into Austin, maybe it's a good time in 2025. For me, I still like to be in areas outside of Austin. We haven't really invested in Austin. I kind of wish in hindsight, that I had, but it just didn't have the kind of cash flow that Dallas and Houston and San Antonio have. But all those cities have really strong growth too. So I've just chosen over the years to go into higher cash flowing markets that are also seeing a lot of growth. And so to me, it's still Dallas. Dallas, oh my gosh, I'm so boring, but it's been 20 years that I've been bullish on this market, and it just keeps growing. But what's kind of beautiful about Dallas is you could still get a brand new property in the 200s, like 220,000, 250,000. We have an incredible team at RealWealth that keeps finding our investors these new markets within the Dallas area. And I'm not, when I say Dallas, I'm absolutely not talking about Dallas proper. And a lot of people get confused about that because Dallas data that comes up in the Case-Shiller Index or in other indices or other reports that you see, they might be just talking about Dallas proper. We rarely invest in a city. We invest in the suburbs where families want to live, where businesses are moving, where it's more affordable. Most cities are pretty expensive because there's a limited amount of land. So companies who want to build big factories or, put their headquarters, they're going to do it where it's cheaper, which is in the suburbs. So you got to find out, where are those companies going? And our team in Dallas just keeps showing us where the growth is headed, where companies are moving for cheaper land, where builders are moving for cheaper land, where people are moving because it's more affordable and because their jobs are moving out there. So we're seeing still a ton of growth in North Dallas. We're seeing, almost all the way to the Oklahoma border, like growth is massive. Some of the cities that we invested in just last year, we cannot invest in anymore. They don't make sense anymore. They were affordable last year, not today. So we just keep following this path of progress. And even the Fort Worth area has got some great opportunity because it's a little bit less expensive than the Dallas area. So again, you can get details and contact information for our teams in both Fort Worth and Dallas to see the amazing rental properties that they're able to provide investors in those markets. And they have property management in place. Okay, the worst market, and gosh darn it, I pick on this city all the time. And I'm sorry. I'm sorry for anyone who lives there and invests there. This is just my opinion, and forgive me for that. But Jackson, Mississippi, I bring it up all the time because it seems to be a place where a lot of investors invest. And I can see why. On paper, the numbers look amazing. The properties are still so cheap. You can get them in the hundreds, like even 100,000 or 150,000. And the rents come in pretty high. So on paper, if you're just looking on the MLS, like, ooh, this looks good. This cash flows. But when you look at a place where a property is still downtown, like we're talking near the city and just outside in the suburbs, if the price is still in the hundreds, you're in an area that just doesn't appreciate. It just does not go up in value because I was seeing the same prices 20 years ago. So it just stays flat. And why is it? Is it just not growing? Are businesses just not moving there? The problem with a flat market, I know it's good for cash flow, but if you're buying a property that needs work, that's older, the minute you have a repair, you've lost all your cash flow because you're not gaining, you're not making it up in appreciation. I bought a property in Cleveland for $50,000 back in 2015 or something. And then it went up, it doubled in value, right? So, wow, it was like 100,000. And it cash flowed, it rented for the 5 years that we had it. And same tenant, never missed a payment. It was our best performing cash flow property. And then we had a problem with plumbing, and a major problem. And it ended up being a $24,000 problem. Like, this doesn't happen all the time, but with older homes, you're going to see this kind of CapEx. And when you have a $100,000 property, you're spending 25% of the value of the property on plumbing that no one gets to enjoy or see. It's just hidden under the ground. So, years of cash flow on that property disappeared like that. So I'm not saying not to invest in Cleveland. I'm just saying if you buy an older property that's not already been renovated, you could run into those kind of issues. So if you're buying a cash flow property, make sure you are super careful about identifying the future CapEx, the capital expenditures that you will have. You need to know the life of the HVAC. You need to know the life of the roof. When are you going to have to replace these things, and how much do you need to set aside to do that? Now, we always put reserves in our pro formas for repairs, but very, very rarely does anyone put the kind of reserves that you're really going to need on an older property, because you'd be putting $500 a month, to if you have to fix HVAC, it's going to be a lot of money. So just when buying a cash flow property, you've got to know what you're acquiring and what kind of investment you're going to have to make in this property to truly determine your real cash flow. And that's the mistake that way too many people make. That's why I've been more positive about turnkey property, because investors can go in and buy a property that's already renovated. Now, not all turnkey does that. At RealWealth, we've had standards for what turnkey means. Turnkey means absolutely nothing. We gave it a definition that, we want to see at least 5 years left on the roof. We've got it all listed on our website at RealWealth, what we consider a turnkey property. We call it real income properties. And if you're going to buy an older property, it should come with an understanding of what your expenses are, and that a lot of those things have already been taken care of. All right. That was a really, really, really long answer to best and worst markets, but hopefully it was educational. And now we've got the wild card. So we do have a new administration coming in. And what we've seen in Trump's first term is that he knows what he wants, and he tends to get it. I mean, he battled with the Fed back then. The Fed was raising rates. I believe it was 2018. And the Fed was raising rates. Now, this was great for us because Rich and I were able to buy the property of our dreams, because when the Fed raised rates, the housing market came to a standstill in 2018. And we got a crazy good deal on some land. And that was great for us. That's why I remember the date. But the Trump was really upset that they were raising rates. He didn't think that they should be. And normally presidents don't argue with the Fed, but he did. And I don't know how it played out, because the Fed is supposed to not listen to anyone. They just look at data. Pretty soon after that, the Fed started lowering rates. So, we've got a president who coming in who may have a little bit more influence on things like this. There is a way, kind of a secret way, to lower mortgage rates, and it's called quantitative easing. And that's basically when the Fed buys mortgage-backed securities. They buy the bonds. When the bond investors aren't buying it, someone needs to buy it. And the Federal Reserve, has sort of been the buyer of last resort, the bond investor of last resort. Now, recently, because there was so much of this happening during 2020 and 2021, the Fed is trying to offload some of these bonds that they bought. So it would be unlikely that they would do this now, because they already bought so many bonds, they're trying to get rid of them. But if there was some manipulation in the background, that is one way that we could see mortgage rates go down in 2025. Like I said, if that happens, oh my goodness, just watch out. The housing market is going to be nuts, because that's how we got rates so low, during the pandemic. Okay, what other wild cards are there? Here's another one to pay attention to. If we do see more inventory, more housing inventory, that's going to really influence builders to slow down on building. You're going to see fewer starts. And that is going to kind of spiral into a lot of job losses, because a lot of people don't realize that the housing market is really a huge driver of our economy, a massive driver of our economy. And when construction starts to slow down, our economy starts to slow down. So if we see kind of a lot of increase in inventory and rates get to a point where buyers just can't buy, just can't afford it, then we could see builders stop building. They're not going to be incentivized to do so. And that could really spiral into job losses, which then would have the Fed go, ooh, job losses, we're going to lower rates. And if they lower rates, then the bond market might follow and say, oh yeah, that we're starting to see the economy slow down. Those are just a couple of the wild cards to pay attention to. So I'm going to summarize this with my crystal ball is telling me that we, once again, have absolutely no idea what 2025 holds in store for us. And I want you to know that that's okay. That's okay, because what I have found over the last 30 years that I've been a real estate investor, we've had all kinds of different presidents. We've had presidents who were very Republican, very Democrat. We had all kinds of things happen in the last 30 years. And you know what still worked out? Cash flow real estate. Real estate, basically the strategy that we've been using at RealWealth for 30 years. I mean, RealWealth has only been around for 20 years, but Rich and I have been investing for 30. And this is what we've seen time and time again, that if you can get into a market where there is job growth, population growth, where there's infrastructure growth, where it's still somewhat affordable, where the average person can afford to live there, then you are in the path of progress. And it doesn't matter what's happening anywhere else. What matters is that most people still prefer to live indoors. They still need a place to live. And if you're able to provide affordable, clean, safe housing, you're going to be okay, especially if you're doing this type of business in a business-friendly environment. Now, if you're buying a bunch of rental properties and putting them on the market in California, it's a wild card. You don't know what the California government's going to do in terms of rent. It's going to be rent control. Who knows? But if you are providing this affordable housing in a growth area like Dallas, and you see all the growth happening there, regardless of pandemics, regardless of housing recessions. I mean, Dallas was still growing in 2009 and I don't mean Dallas proper. They had some issues, but in the suburbs, our investors who invested in the suburbs of Dallas where there was growth happening, they didn't even feel the housing recession of 2008. They didn't feel the recession of COVID because people still need a place to live that's affordable, clean, and safe. All right. Well, I hope this gives you some idea of what to expect in 2025 and where to put your money and how to invest. Thank you so much for joining me here on the Real Wealth Show. And if you want to hear more of my predictions, I will be giving my 2025 housing forecast at our upcoming live event in January 18th in just south of San Francisco, really close to the airport. We're going to be bringing in 10 different teams from around the country who have property management in place, who are able to find properties that either have been totally renovated or are brand new to make for a turnkey investment for out-of-state investors. So I hope you join us there. You can find out more at realwealthshow.com. Just click on the Connect tab and you'll see the drop down for live events. I really look forward to seeing you there. And don't forget, Rich will be doing his Focused Investor presentation that he's done every January. People love it. It gets people really ready and focused, prepared for the new year. So don't miss it. We look forward to seeing you there. Thanks for joining me here on the Real Wealth Show. Again, you can go to realwealthshow.com for more details.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.